Los Angeles is collapsing, sparking a nationwide disaster. I'm Steve Van Metre. Global trade is plunging, confidence is crashing, and you won't believe what's going to get hit next. This trade war crisis is just beginning. Now let's find out why Los Angeles is the likely epicenter of this crisis as we pick today's story up with the headline. Trade war shock looms for Port of Los Angeles as Goldman identifies most impacted products. And you're going to see this dominate headlines. We're going to see empty shelves on stores. But that's not the real story, because the reason Los Angeles is at the epicenter of this trade war crisis is because it's all about global trade and shipping. And what we're finding out is the number of ships coming into the Port of Los Angeles is going to decline substantially as we get into May. Now, the real issue here for the average worker is those at the port are going to start to find out that their hours are going to get cut. And amidst higher inflation, it means their spending is going to drop. And what we're going to find out is this is going to quickly spread all across the country. And wait till you find out what's next. It's absolutely terrifying. Earliest trade war tracking coverage of critical U.S.-China supply chain shows that China's export manufacturing base has already been severely impacted, with shockwaves thundering across the Pacific. And those shockwaves are the ships that are going to start showing up in the Port of Los Angeles here in the near-term future. And it's going to be a very strong indication of the absolute collapse in demand. But what have we seen in Chinese factories? Well, we talked about this the other day. They're seeing mass furloughs. They're seeing a huge drop in demand to the point where some factories are looking at shutting down. And if you think that the U.S. is immune to what's happening there, hang tight. In a matter of months, we're going to see the same thing. And ports along the U.S. West Coast, particularly the Port of Los Angeles, are now bracing for a sharp plunge in containerized imports in the coming days. From Port Optimizer, a tracking system for vessel operators, shows the declines begin on Sunday. And this is dangerous because when we take a look at this latest data, what we see is a huge decline from last year. As we see, scheduled vessels coming in from May 4th to May 10th are set to drop over 30% from this time last year. And I want you to understand the risk here, particularly for all the people in the transportation sector, especially those centered at the Port of Los Angeles and other ports across the United States. They're going to see a significant cut in the number of hours. Now, employers aren't going to immediately cut jobs. What they're going to do is they're going to cut hours, then they're going to cut job openings, and if this persists, then jobs will get cut. But the real issue here is take-home pay has already been shrinking against inflation, and now, based on what we're seeing, a big decline in the number of ships coming into U.S. ports is going to mean substantial pay cuts for those in the transportation sector, and that means their spending power is going to decline, and that's going to reverberate all across the U.S. economy. And Goldman has created a tracker and is working with 46 corporates and products representing 70% of the China export value to gauge the speed and size of changes as they happen. An early read suggests substantial impact on Chinese exports to the U.S., with the most impacted products being white goods, appliances, batteries, and selected commodities. But here's the other issue. China isn't the only country that got hit with tariffs. Everybody did. So that means this is just a sign of what we're seeing from China. This is going to quickly spread all across other countries as we see ships from all over the world start to decline as they come into U.S. ports. And again, what we know is there's a huge demand for labor due to imports. And as imports into this country go down, well, it means we're going to see job losses. The job losses we're seeing in China, well, that's just because they're at the beginning of the supply chain. Now, I want to know from you, are you tied to the transportation sector? Are you worried about either losing your job or seeing hours get cut? Is it already happening? Weigh in the comments below. I'd love to hear from you. Because pricing discussions have started, but no clarity on pass-through, as some corporates are not seeing enough margin to absorb tariff impact. And we knew this from the beginning because a lot of businesses run on very low and thin margins, meaning they don't have the ability to pass on large tariffs, which means we already know that prices are set to rise as those in the transportation sector are going to see their take-home pay shrink. And corporates are also pointing to the U.S. inventory buffers, well, at least for now. Keep in mind, this is old inventory, as producers that are prepared ahead seem to have a 3 to 6 month inventory buffer in the U.S., with price hikes being planned once those low-cost inventories have been depleted. Of course, we know there will be businesses that are going to raise their price because they're desperate to increase their margin. But what have we already seen in the data is that the cure for higher prices is higher prices, and the consumers are already rejecting them. And this is a major problem because despite the fact that, again, we have 3 to 6 months of potential inventory, it's old inventory. And we know consumers want the newest and latest things, and those are going to be subject to the tariffs. And forward-looking container shipping data are pointing to a greater than 27% fall by the third quarter of 2025. So what we're seeing is if this trade war does not end and end soon, we're going to see a huge collapse in global trade that's going to start next month. This is going to lead to, again, lots of hours getting cut for workers. And then by the third quarter, if this persists, you're going to see huge amounts of job losses because employers won't be able to sustain. But something that should be rallying despite what's going on in the economy, that's your trading account. We put this buy order on GBTC, this is Bitcoin, back on April 14th for Momentum Timer Pro subscribers. As of the close of business Friday, they're up 12.31%. And how do we do it? Well, we look at those technical indicators, but we pair it with the trend. So when we see the trend rising out of oversold condition, we put that out to our subscribers and they make money. And here's the best part, you can too. Grab the links in the description below and use a coupon code for your free 30-day free trial. Stay tuned to the end of the show for more information because a lot of people are going to be looking to make extra money, and it's starting now with the transportation sector. Let's turn to Craig Fuller of Freight Alley, and he says, imagine what would be like if the economy showed no growth for 7 years. This is from a post on X. That's how the trucking market feels for truckers right now. Truckload volumes have dropped to 2018 levels as phase one of the trade war is showing up in the market. So it's not just the people at the ports, it's people that are going to be all along the transportation supply chain here. And this is an issue because, again, what is going to happen with truckers? They're going to see demand go down. That means the amount of work and loads they can move are going to drop, their pay is going to drop, and we already know prices are set to rise. We know food prices are likely heading higher this summer. That means less money to be spent on the discretionary side of the economy that's going to roll into other people on that side of the economy, getting their hours cut, their paychecks shrinking, demand plunging, and you can see by the third quarter it's going to be all-out chaos here in the United States. And this is the reason Chinese delegation has been spotted entering the Treasury Department as demands but photos be deleted. And why is that? Well, we've heard from President Trump. He's made it very clear that there is negotiations going on, but there's confusion because the question is, has he or has he not spoken to Xi Jinping? But he doesn't want to comment on that, but I've spoken to him many times. But here's the other part, is China said the other day, we're not talking to the United States right now, but yet, well, this picture says otherwise, and it starts to make perfect sense because here you can see some high-ranking officials from the Chinese Ministry of Finance entering the Treasury building located right next to the White House in Washington, D.C., accompanied by 10 attendants. Because when you start to zoom out and look at what's really going on around the world, we go back to China's manufacturing base. What's happening? Factories starting to shut down, demand plunging, workers getting furloughed with no opportunity to work. And the problem in China is they don't have a social system to provide unemployed workers benefits. And now what's happening? It's impacting transportation and trade. We're going to see this hit U.S. ports here starting today and then going into next week and next month. And then after that, what's going to happen? It's going to impact the trucking sector. You're going to see incomes go down across the board. Spending is going to drop. Prices are going to rise. And so you see why China is so desperate to make a deal. Well, we're going to be desperate too. The fact that the treasury channels of both the U.S. and China are actually operating means that both countries have reached a critical point under domestic and international pressure due to the current retaliatory tariffs. And the result of the backroom negotiation between these two sides could be a major turning point in the tariff war. And the reality is I don't think the U.S. economy makes it to the third quarter. At what we're seeing now, I don't think the Chinese economy makes it more than a couple months at best before they plunge into an all-out recession. But I want to know from you, what's your timeline? How long do you think this lasts? Is a 3 to 6 month inventory level enough? Or are we on the cusp of an all-out global financial crisis? Tell me the number of months. Weigh in the comments below how long before we hit and start to plunge along with everybody else. Because U.S. consumers are already had enough as sentiment slides while inflation expectations jump. And right now, consumers are pricing in massive increases in inflation. And we talked about this the other day that Chipotle said, which I find very interesting. The company that makes burritos said that people are saving money instead of spending money on burritos. But the reality is that's what happens in periods of high inflation. If paychecks aren't rising and people realize I'm going to have to buy things in the future, I need to start setting money aside so I can afford it. And that makes perfect sense of why demand for burritos and other consumer discretionary items are declining, because people are saying, I've had enough. And on top of that, they're worried about their finances. And U.S. consumer sentiment fell to one of the lowest readings on record, and long-term inflation expectations climbed to the highest since '91 on fears of the economic fallout from tariffs that's going to start on Sunday, at least at the Port of Los Angeles. The final April sentiment index fell to 52.2 from 57 a month earlier, this according to the University of Michigan. And while slight improvement from the preliminary gauge of 50.8, the latest figure is the fourth lowest in data back to the late 1970s. And as we warned, that a plunge in confidence would eventually lead to a plunge in demand. So what you see is there's a lag. As consumers lose confidence, they start to save more and spend less. It impacts retail sales. So it's notable that a lot of these businesses are saying, well, we have plenty of inventory. Well, it won't matter, because when consumers quit spending, they're going to have to cut prices to move this inventory, because at some point this trade war is going to end. There's going to be huge influx of goods, and what are consumers eventually going to want? The latest and greatest, not the old and busted. As U.S. consumer sentiment now continues to languish on tariffs, and we can see sentiment plunging back to where it was in late 2021 going into 2022 at the same time, well, what we see is inflation expectations are going vertical. Labor market expectations remain bleak. Even more concerning for the path of the economy, consumers anticipated weaker income growth for themselves in the year ahead. And this is a major problem, because consumers, when they feel optimistic about their finances, they go out and spend. But what we're seeing is consumers saying, look, we're not confident about our finances. In fact, we see that our pay growth is going to shrink. And why is that? Because demand is shrinking. They're going to work and they're not seeing a lot of new business. They're seeing the old business get worked through. And for employers, it's very simple. If your employee demands huge wages, you can simply go to the unemployment line and find someone who will likely work for less. And what this means is, as pay growth declines, I'm going to show you, it means the unemployment rate is about to surge. And without reliably strong income, spending is unlikely to remain strong amid the numerous warning signs perceived by consumers. And that's absolutely right. As prices rise faster than wages, particularly if the issue is that wages are set to shrink as hours get cut, well, it means consumers will have no choice. They are going to cut back, and that's going to be the wrong move at the wrong time for the economy, because as we've seen in the past, every time consumers cut spending, we go right into a recession. Let's take a look at average hourly earnings of production and non-supervisory employees. This showed in blue on a year-over-year rate of change against the unemployment rate. And we can see going back in the late 1980s that employers were giving out large earning increases until we got right into 1990. That got slashed as we went into a recession. And look what happened. At the same time, the unemployment rate rose. And again, businesses realize you can give the employees you want to keep raises, but you don't have to give them big raises, because the alternative is the unemployment line. And you can see this happening going into every recession. Pay growth slows as we enter the dot-com bubble. At the same time, the unemployment rate rises. We see in the years leading into the global financial crisis, pay growth slowed, the unemployment rate went up, and then we're starting to see it now. Pay growth expected to fall even further. That means the unemployment rate is rising, which is why consumers are flagging in their surveys. They're worried about their finances, they're worried about the job market, and they're worried about getting another job if they lose one. And about 2/3 of respondents see their inflation-adjusted incomes falling in the year ahead. Nearly as many expect the unemployment rate to rise, and there's the evidence. They know what the Fed doesn't know, and that is the labor market is about to come unwound. I don't think it makes it more than a couple months. I think we could start seeing the unemployment rate rise as soon as the end of next month. But I want to know from you, weigh in the comments, because we're already seeing signs that consumers are cutting their spending. Plane tickets are getting cheaper as domestic travel demand weakens. We talked about Southwest Airlines the other day, but nobody really relishes uncertainty when they're talking about what they could do on a vacation and spend hard-earned dollars. This from American Airlines CEO. This means airlines have too many seats on their hands once again, and they will cut back their capacity growth plans after what they still hope to be a strong summer travel season. But keep in mind, if summer starts to come unglued and they start to have extra capacity, what's going to happen is airlines will cut the number of flights. They're going to have to cut jobs. They're going to cut hours. They're going to make the necessary cuts. And if we continue to see that, it's just another red flag for the U.S. economy. If uncertainty pops up, the first thing that goes away is corporate travel. Now, we saw it rising at the beginning of the year, but likely to fall because business travel is one of the key to major carriers because these customers are less price sensitive and often book last minute when tickets are likely to be more expensive. But what's now going to lead to is an overhang of seats in the domestic skies will force airlines to cut prices, which they're doing now to fill planes. But if that doesn't work, if lower prices do not entice consumers to spend, again, they're going to cut capacity, they're going to cut hours, they're going to cut jobs, and it's all going to start to hit. We're going to see this starting Sunday in Los Angeles and watch it spread all throughout May. But lingering concerns are still weighing on the industry. As certainty will restore the economy, I think it will restore it pretty quickly. Well, I disagree with that because the longer this trade war persists, the more likely we're going to be entering a recession. And when people believe that, they're going to cut their spending. And just because it changes doesn't mean businesses are going to turn around and immediately hire. But not to worry, the Fed's going to be late. And now everyone's saying it's a good thing. And for the Fed's pal, being Mr. Too Late is better than being wrong. And you're going to see a lot of messaging about this in the weeks and months to come, particularly because the Fed's next meeting is May 6th to 7th. And a lot of people want the Fed to remain independent. So now they're going to come out and say the Fed is late and they're going to always be late. And that's the right move. Now, of course, we know the Fed's late because, well, they always use lag data, which the government publishes. But it makes sense because there isn't a lot of real-time data the Fed could make a monthly adjustments to. But here's the real issue. It comes back to the Fed's going to be late, and now the markets tell him it's okay. And only a few months ago, Powell was steering his colleagues and the economy toward a so-called soft landing, a scenario where inflation and interest rates glide lower while the unemployment rate remains low. Trump's sweeping tariffs have upended the outlook, raising expectations for weaker economic growth and higher inflation. And that's called stagnation, my friends, because all that needs to happen next is the labor market to go. And based on what we're seeing in the trade and transportation data, it's going to start hitting in May and in a big way. They prefer to be late than wrong. They're going to wait and see how things play out on both mandates, as Fed officials are expected to leave rates unchanged when they next meet for their two-day meeting in May 6th to 7th. So now the market's already telling the Fed, you don't have to cut, means they're not going to. But it's not about the inflation mandate. We're going to hear that from Powell because you want the Fed to cut? Well, watch the labor market go, and the Fed will be cutting faster than you can imagine. In recent weeks, Powell and his colleagues have warned that the inflationary impact of the president's import duties could be more persistent than expected and emphasized the Fed's job to make sure that any pickup in prices is limited. So to contain demand, to further reduce demand, the Fed's saying we're not going to let interest rates go down. Now, I want you to understand why this makes no sense, because if you want people to borrow money, well, you should cut rates while they have a job so they perhaps borrow money and afford higher prices. Instead, the Fed's saying, no, I'm not going to do that. And that means maintaining a tight posture on interest rates to keep expectations about prices under control and holding rates steady absent a substantial rise in unemployment. And there's the key, because when you take a look at rising consumer prices, we talk about the cure for higher prices is higher prices. And at some point, the Fed says we care about higher prices until the unemployment rate goes here. You can see in 91, the unemployment rate took off. You can see it going to the dot-com bubble, again, the global financial crisis. And this was all happening amid higher prices, which we can expect now from the tariffs. But here's the expectation, because they were close to nailing a soft landing, the experts said. The biggest mistake the Fed can make would be to instill additional inflation as the economy weakens, because everybody thinks that if you actually lower interest rates, you get higher inflation. But it's all about the labor market. And based on what we're seeing right now, hours are going to get cut, and then we're going to see job openings yanked. And after that, jobs are gone. And that means the Fed will cut, and cut aggressively. Here you can see now, overlaid against the unemployment rate in red is the federal funds rate in blue. You can see as the unemployment rate rises, Fed could care less about inflation, because when people are out of work and they don't have the extra money, they don't spend. And that, again, is a cure for higher prices, is joblessness and higher prices. You can see it happen again. You go in the dot-com bubble, the global financial crisis, and we're set to see the Fed cutting again, perhaps maybe in June, based on what we're now starting to see in the economy. But just because the economy's unwinding and your paycheck might be shrinking doesn't mean you can't make money trading the market. Check out this trade on Bitcoin. We told our subscribers to buy right here on this green candlestick, and next thing you know, it took off. How do we know it? Well, because we look at the tactical indicators every day for our Momentum Timer Pro subscribers, and we pair it with the trend. So every day we look at the broad equity, bond, currency, commodity markets, and we aggregate those tactical signals together, and we look for things coming off oversold conditions, and then we pair it with the trend. We look at it over the 1 day, 1, 3, and 6 month windows, and when it flags, we have that calling on our hot list, and we give you the daily report every day in addition to those hot trades and all the other signals our report generates. But one of the best parts is I give you my opinion on the best trades. I give you risk control levels, a full tracking of all of our open trades and returns, a weekly update, and yes, the absolute best part of this is you don't have to put a dime out to try it. We have a 30-day free trial. All you have to do is grab the links in the description below, use a coupon code for your free 30-day free trial, and start making money trading these markets with our momentum signals. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.